All right, good day, everyone. Welcome back to my YouTube channel at Illumination of NG. Kindly subscribe to my YouTube channel and also click on the notification bell so that you can have access or information on any video I'm going to be dropping later. So, like I mentioned in my previous class, the reason why we created this channel is to educate people, most especially those who are students in various colleges, universities, and those who are professionals or those who are learning or who are new to the world of accounting. Today we're going to be looking at depreciation, okay, and what depreciation entails. So we're going to be looking at depreciation. So we're going to be looking at depreciation. So what do we mean by depreciation? In a layman's term, we say that it is the wear and tear of an asset. That is the reduction in value of an asset due to some certain factors. And those factors can be technological factors, they can be due to usage, they can be obsoleteness, and also they can be as a result of economical factors. And so all these factors will further reduce the value of an asset within its useful lifespan. Okay, so that is the value of an asset today that you have put into use will not be the same in the future time. Okay, so and that is why organizations are required to make provisions, okay, for the assets, so that whenever they lose their value, they can easily be scrapped and replaced. Okay, so right now today, we all know that there are various methods of calculation. We have the straight line method, we have the reducing balance method, we have the straight line method. There are various methods. Okay, we also have the evaluation method, we have the machinal method, we have the sinking fund method, and others. But in this video, I'm going to try as much as possible to touch some of those methods. Okay, so we're going to look at some typical questions. So let's assume that an asset, okay, the cost of an asset. Okay, so let me try and click on that. Sorry for that. Okay. Okay. So I don't know why this thing is slow to respond. So let's go ahead. Let's assume that the cost. Well, I don't know why the pen is not responding, but I'll try as much as possible to find a solution to this. So we're talking about the cost of an asset being valued at. So let me just check what is wrong. Okay, so let's get back to the video. Okay, so okay, the cost of an asset, the cost of an asset, okay, is equal to 30,000 naira. Let's call it 300,000 naira. Okay. So the cost of the asset, let's assume that it's 300,000 naira. And the scrap value of the asset, this scrap value is also known as the residual value or the salvage value. Okay. So let's assume that the salvage value is 20,000 naira, 20,000 naira, and the lifespan, okay, the lifespan of the asset is 4 years. Okay. So let us work on this and let us find a way to determine the depreciation value as well as the depreciation rate. Okay. To calculate depreciation, so we're going to be adopting the straight line method, what we call the straight line method, which is a method that enables us to allocate the same depreciation value over the useful lifespan of that asset. Okay, so we have depreciation equals cost minus the scrap or salvage value, of the asset all over the useful lifespan of the asset. Okay, so depreciation equals to the cost, which is 300,000 naira, 300,000 naira minus 20,000 naira, which is the salvage value of scrap value, 1,000 over 4 years. Okay, so at the end of the day, we're going to be left with 280,000 naira divided by 4. So in this regards, we're going to be having 70,000 naira. 70,000 naira. So depreciation. So this shows that for a period of 4 years, the assets will depreciate at the value of 70,000 naira. So at what rate? At what rate did the asset depreciate? Okay, since we have a scrap value or salvage value for this asset, so the depreciation rate, the rate equals to the depreciation value itself, 70,000 naira, okay, over 280,000 naira, okay, multiplied by 100. Please don't make the mistake of writing 300,000 because this is the initial cost and we still have a scrap value left. Okay, so let us do the mathematics. Let's cancel this off. This here 1, this here is we have 4, then we are left with 25%. Okay, so the assets will depreciate at 25%. Very simple. So now that we have the depreciation value at 70,000 naira, okay, meaning that the asset is going to depreciate over the years. So using the straight line method, so we're going to go around it to prepare the book of account. Okay, so in this case, we're going to be preparing the asset account. Okay, we're going to be preparing the so let's go ahead and do that. So we have assets. We have the assets. It can be plant and machinery. It can be depreciation. It can be land and buildings. It can be any form of asset, etc., depending on what is being used in the question. Okay, so we have asset account. Okay, so let's open the ledger account, asset account. So we have this first. We have, let's use here for the cash account. Okay, so the cash account, we have it here. So for the asset account, is when we bought the asset. Okay, let's say for year 1, the cash value paid for the asset is 300,000 naira. At the end of the year, the depreciation. So let's say it was once we receive the asset, this is the receiving side. Okay, we have debit, we have credit. Okay, we have debit, we have credit. Okay, so since we are paying in cash, okay, you can now see assets. Okay, so the value is how much? That is 300,000. So we've completed the double entry principle here in this case. So for depreciation, we have for the end of the year, that is year 1 December of that year. So we have naira sign, okay, we have 70,000 naira. Okay, so the balance carried down is 230,000 for the first year. So that is 300,000 at the end of the year. 300,000, 100,000. Okay. So for year two, so bring down balance brought forward. Okay, brought forward, we have 230,000. So since we are using this straight line method, we're going to see adopt the same depreciation value of 70,000 naira. Okay, so 70,000 naira, we're going to see adopt the same 70,000. Okay, so say balance carried down again. That is 160,000. 60,000. So this is how you're going to prepare your account. 50,000. Okay. Don't know why the pen is so slow in responding. Okay. So let me find a way to just finish this up. So for year three, we have balance brought forward. Okay. We have 160,000. 60,000. Okay. This is 160. We have December of that year. Okay, we have another 70,000. You can see that the depreciation value is uniform. That's why we call it a straight line method. It is uniform. The same value is carried on for the 4-year period. Okay, so we have balance carried down. We have, that should be 90,000. So we have, well, so let's close that, 160,000. Okay, it's 160,000. Okay, 60,000. So let's move on. So for year four, because the asset used 4 years, we have balance brought forward. Okay, we have 90,000. We have depreciation. We have December of that year, 31. We have the value of this is depreciation. Okay, this is depreciation. This is depreciation. Sorry, not this. This is depreciation. Okay, this is depreciation. Okay, so depreciation is 70,000 again. So we have balance. We have a balance carried down of 20,000, which is the scrap value that we have in the question. Okay. So in doing this, we have finished up with the straight line method. So let's post into the other accounts before our time lapse. Okay. So let's go ahead and post this into the depreciation account. Okay. So in the depreciation account, okay, depreciation account. So for year one, we have machine. So depreciation value is 70,000. So this will go to the P&L account. Okay, POL account, L account. Okay, that is 70,000. Okay, year two, we have machine. Okay, we have 70,000. We have December. Okay, December. The first, we have POL account, that is 70,000. So for year three, machine, 70,000. Okay, December 31st, P&L, 70,000. Okay, so for year four, we have machine, we have the same value, 70,000 naira. Same of that year, POL, we have 70,000. So vice versa. Let's close that. Close that. Close that. So let's close that on. Close that. Close that. Close that. So this will be posted to the debit side of the POL account. Okay, account. POL account, we're going to have year one, we have depreciation. Okay, we have 70,000. Year two, depreciation, 70,000. Year three, depreciation, 70,000. Year four, depreciation, 70,000. So this is how you're going to post. appear on the other account.